Intermediate Accounting, Chapter 6, Revenue Recognition. Chapter 6, Revenue Recognition, 1 of 2. After studying this chapter, you should be able to 1. Understand the economics and legalities of selling transactions from a business perspective. 2. Identify the 5 steps in the revenue recognition process. 3. Identify the contract with customers. 4. Identify the separate performance obligations in the contract. 5. Determine the transaction price. 6. Allocate the transaction price to the separate performance obligations. 7. Understand how to recognize revenue when the company satisfies its performance obligation. 8. Analyze and determine whether a company has earned revenues under their earnings approach. 9. Identify other revenue recognition issues. 10. Describe presentation and disclosure regarding revenue. 11. Identify differences in accounting between IFRS and ASPE and potential changes. Revenue recognition. Understanding the nature of sales transactions from a business perspective. Economics of sales transactions. Legalities of sales transactions. Information for decision-making. Recognition and measurement, the 5-step process. Basic accounting, contract modifications, material rights, warranties, upfront fees, series of goods and services that are substantially the same, value consideration, time value of money, non-cash consideration, consideration paid or payable to customers, selling goods, selling services, measurability, and collectability. Other recognition issues: repurchase agreements, bill and hold arrangements, principal-agent relationships, consignments, summary of other revenue recognition issues. Presentation and disclosure. Presentation, disclosure. IFRS ASPE comparison. A comparison of IFRS and ASPE looking ahead. Understanding the nature of sales transactions from a business perspective. Accounting for when revenue should be recognized is complex. Much of the complexity is caused by the structure of the sales transactions. To account for transactions properly, it is important to understand the business the entity is engaged in. Understanding what the company is selling will help to determine when to recognize revenue, what is being given up, and what is being received. Decision when to recognize the transaction and how to measure and present it are key. Economics of sales transactions, 1 of 4. What is being given up? Sales transactions involve transfer of goods, services, or both, known as deliverables. Sales of goods and sales of services are different. Sale of goods. Tangible assets with finite point when control transfers to buyer, and the buyer has access to the benefits of ownership, generally with transfer of legal title and possession. Sale of services. Non-tangible, so possession and legal title are irrelevant, could span more than one period. How much revenue is earned in each period? Sale of goods and/or services combined. Complexity in measuring each component of bundled sales or multiple deliverables and knowing when to recognize revenues. Economics of sales transactions, 2 of 4. What is being received? Most business transactions are reciprocal. Some consideration is provided in exchange for goods or services. Cash or cash-like, monetary. Non-monetary, another good or service, also known as barter. These terms are usually specified in the sales agreements: amount, nature and timing of consideration or rights acquired, deliveries, quantities, nature of goods and services, timing, shipping terms for goods and services given up. Generally assume that the transaction is at arm's length between unrelated parties and reciprocal, such that the value of deliverables sold equals the value of consideration received. Economics of Sales Transactions 3 of 4. Concessionary terms. Are the terms of the sale normal, or is this a special deal? Concessionary terms are terms negotiated by a party to the contract that are more favorable than normal. In some cases, they may create additional obligations or may indicate that control has not passed to the buyer, no sale. In turn, this may give rise to additional recognition and measurement risk. Need to differentiate between what is normal and what is abnormal in terms of business practices. Some practices, like deep discounts, may be a normal part of one company's marketing strategy, but abnormal for other entities. Economics of Sales Transactions 4 of 4. Examples of normal selling terms and examples of concessionary selling terms. Selling price, normal. Selling price reflects a normal profit margin for the company for that product. Concessionary. Selling price is deeply discounted. Payment terms, normal. Sell for cash or on credit. If credit, payment is usually expected within 30 to 60 days. Concessionary. Any terms that are more lenient than this, for example, selling on credit where the buyer does not have to pay for 90 days or more, or installment sales where these are not normal industry practice. Extension of credit, normal. Sell to customers that are creditworthy. Concessionary. Sell to customers that are riskier than the existing customer base. Shipping terms, normal. Ship when ordered and ready to ship. Concessionary. Ship at a later date. For example, the entity may hold the inventory in its warehouse for an extended period. Other terms, normal. Once shipped and legal title passes, no continuing involvement except for normal rights of return and/or standard warranties. Concessionary. Extended right of return and warranty period, cash flow guarantee on future rental of buildings sold, profit guarantees on future resale, or buyback provisions. Legalities of Sales Transactions. The act of entering into a sales agreement creates legal rights and obligations for both the entity and the customer. Contract law is more relevant as each sales transaction represents a contract with the customer. A contract may be written, verbal, or evidenced with some other artifact, for example, cash register receipt. A sales contract generally identifies the point when legal title and possession of goods sold pass to the customer, for example, physical possession of the goods immediately, FOB shipping point, or FOB destination. Implicit obligations not specifically outlined in the sales contract, i.e., constructive obligations, may also be enforced under common or other law. Revenue recognition and overview. There are two approaches to recognizing revenue. The asset liability approach, or contracts-based approach, as adopted by IFRS 15, accounts for revenue based on the asset or liability arising from contracts with customers. The earnings approach, as followed under ASPE, recognizes and measures revenue based on whether it has been earned. The performance obligation is satisfied when there is a change in control from the seller to the customer. The asset liability approach to revenue recognition, an overview of the 5-step process. Key objective: recognize revenue to depict the transfer of goods or services to customers in an amount that reflects the consideration that the company receives or expects to receive in exchange for these goods or services. 5-step process for revenue recognition. 1. Identify the contract with customers. 2. Identify the separate performance obligations in the contract. 3. Determine the transaction price. 4. Allocate the transaction price to the separate performance obligations. 5. Recognize revenue when each performance obligation is satisfied. Revenue recognition principle. Recognize revenue in the accounting period when the performance obligation is satisfied. Identifying the contract with customers, step 1, 1 of 3. A contract is an agreement between two or more parties that creates enforceable rights or obligations. It can be written, oral, or implied from customary business practices. Upon entering into a contract with a customer, a company obtains rights to receive consideration from the customer and assumes obligations to transfer goods or services to the customer. A company does not recognize contract assets or liabilities, nor is a journal entry performed until one or both parties perform their contracted obligations. Identifying the contract with customers, step 1, 2 of 3. Apply IFRS 15 to contract if the contract has commercial substance. The parties in the contract have approved the contract and are committed to perform their respective obligations. The company can identify each party's rights regarding the goods or services to be transferred. The company can identify the payment terms for the goods and services to be transferred. It is probable that the company will collect the consideration to which it will be entitled. Disregard IFRS 15 if the contract is wholly unperformed and each party can unilaterally terminate the contract without compensation. Contract modifications can occur while the contract is ongoing. It is recognized as a new contract if both of these conditions are satisfied. The promised goods or services are distinct. The price increases by an amount of consideration that reflects the standalone selling price for which the goods or services could be sold. Identifying the contract with customers, step 1, 3 of 3. Step 1. Identify the contract with customers. A contract is an agreement between two parties that creates enforceable rights or obligations. In this case, Margot Company has a contract to deliver a product to Sun Yun. Here's the example. On March 1st, 2020, Margot Company enters into a contract to transfer a product to Sun Yun on July 31st, 2020. The contract is structured such that Sun Yun is required to pay the full contract price of $5,000 on August 31st, 2020. The cost of goods transferred is $3,000. Margot delivers the product to Sun Yun on July 31st, 2020. March 1st, contract is identified, no journal entry. Identifying separate performance obligations, step 2, 1 of 7. Performance obligation is a promise to provide a product or service to the customer. Promise may be explicit, implicit, or possibly based on customary business practices. The product or service must be distinct. The customer can benefit from it. If a performance obligation is a multi-obligation contract, is distinct within the contract, then it should be accounted for separately. Identifying separate performance obligations, step 2, 2 of 7. Example A. Assume that Genesis Motors sells an automobile to Marquardt auto dealers, not sure if I'm saying these names right, at a price that includes 6 months of telematics services such as navigation and remote diagnostics. These telematics services are regularly sold on a standalone basis by Genesis Motors for a monthly fee. After the 6-month period, the consumer can renew these services on a fee basis with Genesis Motors. Step 2. identify the separate performance obligations in the contract. There are two performance obligations in this contract that are distinct and not interdependent. The customer can benefit from the use of both the car and the service on their own. Identifying separate performance obligations, Step 2, 3 of 7. Example B. Softtech Inc. sells customer relationship software to Lopez Company. In addition to providing the software itself, Softtech promises to perform consulting services, extensively customizing the software to Lopez's information technology environment, for a total consideration of $600,000. Step 2, identify the separate performance obligations in the contract. In this case, the customized software and consulting services have been integrated into one combined item. Even though they are distinct, they are interdependent. One cannot be sold without the other, so should be accounted for as one performance obligation. Identifying separate performance obligations, Step 2, 4 of 7. Sometimes a sale includes an option to acquire a future good or service, for example, loyalty points and coupons, for free or a reduced price. Material right, a right that the customer would not otherwise have been entitled to, should be considered as two separate performance obligations, the current sale and the future sale. Example, when a customer receives a coupon, this is a material right since the coupon can be used to reduce the cost of a future purchase. The goods purchased and the coupon represent separate performance obligations. Identifying separate performance obligations, Step 2, 5 of 7. Companies often provide two types of warranties. Warranty type, assurance, description, provides assurance that the product meets agreed upon specifications in the contract at the time the product is sold. Accounting treatment, represents a cost of selling the product and a warranty liability. Service, description, provides an additional service beyond the assurance type warranty. Accounting treatment represents a performance obligation. At the time of the sale, you would debit warranty expense and credit warranty liability. At the time of the sale, you would debit cash or accounts receivable and credit unearned warranty or unearned revenue. Example, when a company sells a product with a warranty for 120 days and also sells a separate extended warranty for an additional 3 years, the product and the 120-day warranty would be considered one performance obligation because they are interdependent. The 3-year warranty is considered a separate performance obligation because it is sold separately and it is not interdependent. Identifying separate performance obligations, Step 2, 6 of 7. Upfront fees. Upfront fees are payments received before a product is delivered or a service is performed. Membership fees, activation fees, gift cards. Theoretically, this is a material right. However, IFRS 15 allows the whole thing to be treated as one performance obligation. For example, when a customer joins a weight loss group, the initial fee is non-refundable, $72, with a $300 annual fee, which is 50% of the regular annual fee. The transaction would be considered as a single performance obligation, and a revenue of $31 would be recognized each month for the first year. Identifying separate performance obligations, Step 2, 7 of 7. Some long-term contracts provide a series of goods or services that are substantially the same over the life of the contract. Under IFRS, this is treated as one performance obligation. For example, a company enters a 3-year contract with a landscaping company to take care of their plants for a monthly fee. The monthly services are distinct, as the customer benefits from them each month. However, because the service is essentially the same every month, they are combined into one performance obligation. Determining the transaction price, Step 3. Transaction price is the amount of consideration that a company expects to receive from a customer in exchange for transferring goods or services. Transaction price is usually stated within the contract. In other contracts, consider the following: variable consideration, time value of money, non-cash consideration, consideration paid or payable to the customer. These requirements are for companies under IFRS. ASPE has little guidance on measurement, leaving the decisions to professional judgment. Determining the transaction price, Step 3, variable consideration, 1 of 5. Sometimes the transaction price is dependent on future events. Companies must estimate the amount of consideration to determine the amount of revenue to record, called variable consideration. A company recognizes variable consideration only if it is reasonably sure it is entitled to that amount. They have experience with similar contracts and can estimate the cumulative amount of revenue. It is highly probable there will not be a significant reversal of revenue previously recognized. Expected value, probability weighted amount in a range of possible consideration amounts. Most likely amount, the single most likely amount in a range of possible consideration outcomes. When companies are determining the variable consideration, they choose between these two methods, using the one that provides the best estimate. Determining the transaction price, Step 3, variable consideration, 2 of 5. Contract to build a warehouse for $100,000, with a performance bonus of $50,000 based on the timing of completion. Performance bonus decreases by 10% per week for every week beyond the agreed upon completion date. Probability the contract will be completed, 60% by the agreed upon completion date, 30% 1 week late, 10% 2 weeks late. Management should update its estimate at every reporting date. Expected value probability weighted amounts, the transaction price would be 60% times 100,000 plus 50,000. That gives us 90,000. Then 30% times 50,000 times 0.9 plus 100,000. That gives us 43,500. And 10% times 50,000 times 0.8 plus 100,000 equals 14,000 for a total of 147,500. The most likely amount. This is a better method to use if the bonus is all or nothing. It will be paid only if the performance is completed on time. The transaction price in this case would be $150,000 with 60% probability, which is the most likely outcome. Determining the transaction price, Step 3, variable consideration, 3 of 5. Different types of variable consideration. A sales contract that allows the customer a right of return has to recognize the following: revenue from the sale of the product, considering future returns, a refund liability, an asset for its right to recover inventory. Example: Vendon Company sells 100 products for $100 each to Amaya Inc., payable in 30 days. Vendon allows Amaya to return any unused product within 30 days and receive a full refund. The cost of each product is $60. Based on past experience, Vendon estimates 3 products will be returned. The treatments under IFRS and ASPE are different. Determining the transaction price, Step 3, variable consideration, 4 of 5. The sale will be recorded as follows under both methods. Under IFRS, you would have accounts receivable $10,000, sales revenue $9,700, refund liability $300, cost of goods sold $58.20, estimated inventory returns $180, inventory $6,000. Under ASPE, you would do accounts receivable $10,000, sales revenue $10,000, sales returns and allowances $300, allowance for sales and returns $300. Cost of goods sold $58.20, estimated inventory returns $180, and inventory $6,000. Note, under IFRS, revenue recognized is the amount the entity expects to receive, net $9,700. but in order to keep track of the discounts, the entity could use accounts for gross sales and discounts, as long as the net amount is presented in the financial statements. When an item is returned, under IFRS, you would debit refund liability 100, credit accounts payable 100, debit returned inventory 60, and credit estimated inventory return 60. Under ASPE, you would debit allowance for sales returns for 100 and credit accounts payable for 100. You would debit returned inventory for 60 and credit estimated inventory returns for 60. Determining the transaction price, step 3, variable consideration 5 of 5. Some customers may be given a volume discount when buying large amounts. Example, Sung Inc. offers its customers a 3% volume discount if they purchase at least 2 million of its products during the calendar year. By March 31, 2020, Sung has made sales of $700,000 to Arctic Inc. In the previous 2 years, Sung sold over 3 million to Arctic in the period from April 1st to December 31st. Based on past years' experience, it is likely Arctic Inc. will receive the rebate. The potential volume discount should be recognized. Under IFRS, you would debit accounts receivable $700,000 and credit sales revenue for $700,000. You would debit sales revenue for $21,000 and credit contract liability for $21,000. Under ASPE, you would debit accounts receivable for $700,000 and credit sales revenue for $700,000. You would debit sales returns and allowances for $21,000 and credit allowance for sales returns for $21,000. When Arctic Inc. meets the threshold, Sung will make this entry. Under IFRS, cash $679,000, contract liability $21,000, and accounts receivable a credit for $700,000. Under ASPE, cash $679,000, allowance for sales returns for $21,000, and credit accounts receivable for $700,000. Determining the transaction price, step 3, time value of money. In most instances, companies receive consideration after the product is provided or the service is performed. The company provides short-term financing, less than 1 year. Usually, the time value of money is considered only if the contract involves a significant financing component. When a sales transaction involves a significant financing component, the amount of revenue is determined by discounting the payments. The discount rate reflects the customer's credit risk. Report the effects as either interest expense or interest revenue, and no explicit requirement under ASPE, but use the fair value model. Determining the transaction price, step 3, non-cash consideration. When companies receive consideration in the form of goods, services, or other non-cash consideration, they will recognize revenue based on the fair value of what is received. If customers contribute goods or services to fulfill a contract, it should be treated as a non-cash consideration and included in the transaction price, as long as control has passed to the company. Determining the transaction price, step 3, consideration paid or payable. Consideration paid or payable covers items like vouchers, coupons, or gift cards. The impact is to reduce the consideration received and the revenue to be recognized. Example, Ocean Limited sells a $500 gift card to a customer on January 1st with no expiry date. Based on past gift card sales, 85% of gift cards are redeemed and 15% are unexercised. On December 31st, the customer makes one purchase of $50 using the gift card. Expected redemption, 500 times 85% equals $425. January 1st, cash, 500, debit contract, and then credit contract liability for 500. When the gift card is purchased, a contract liability is set up. December 31st, debit contract liability 59 and credit sales revenue 59. The $50 purchase is recorded as $59, which is the 50 times the factor of price to redemption. Allocating the transaction price to separate performance obligations, step 4, 1 of 4. Transaction prices are allocated to more than one performance obligation in a contract based on their relative fair values. The best measure of fair value is what the company could sell the good or service for on a standalone basis. This is standalone selling price. If this information is not available, best estimates are used. All information that is available, like market conditions and type of customer, should be used, in particular, observable information. Allocating the transaction price to separate performance obligations, step 4, 2 of 4. How to calculate standalone prices in preferred order of use. Allocation approach. Adjusted market assessment approach. Implementation. Estimate the price that customers purchasing the goods or services will pay. The company might also look at competitor prices for similar goods or services. Allocation approach. Expected cost plus a margin. Implementation. Forecast expected costs and add a reasonable profit margin. Allocation approach, residual approach. Implementation. Use where the selling price is highly variable or uncertain. Estimate the standalone selling price by starting with the total price for the contract and deducting the observable selling prices of other items being sold. Allocating transaction price to separate performance obligations, step 4, 3 of 4. When the sum of the value of each good and service in a bundle is greater than the transaction price, the total revenue or transaction price should be allocated to the separate performance obligations based on their relative value. So you have a purchase price of $2 million, standalone prices for your first performance obligation, $2 million, your second performance obligation, $20,000, and your third performance obligation, $50,000, for a total fair value of $2,070,000, and you just prorate that by their percentages, and then the allocation based on relative value for obligation 1 would be 1,932,367. For obligation 2, it would be 1,9324, and for obligation 3, it would be 48,309 for the $2 million. Allocating the transaction price to separate performance obligations, step 4. When the selling price of a bundle is less than the individual standalone prices due to a specific component, you have standalone prices. Obligation 1 is 100, performance obligation 2 is 525, and performance obligation 3 is 125. So bundled prices 2 and 3 is 550, and 1, 2, and 3 is 650. The discount should be allocated to the performance obligation that is causing the discount and not to the entire bundle. Based on the separate bundle prices, the 100 discount applies to performance obligations 2 and 3 and should be allocated accordingly. Performance obligation 1, 100. Performance obligations 2 and 3, 550. Recognizing revenue when or as each performance obligation is satisfied. Step 5, 1 of 4. A company satisfies its performance obligation when the customer obtains control of the good or service. Indicators of control. The company has a right to payment for the asset. The company has transferred legal title to the asset. The company has transferred physical possession of the asset. The customer has significant risks and rewards of ownership. The customer has accepted the asset. Recognizing revenue when or as each performance obligation is satisfied. Step 5, 2 of 4. Companies satisfy performance obligations either at a point in time or over a period of time. Companies recognize revenue over a period of time if one or more of the following criteria are met. The customer receives and consumes the benefits as the seller performs. The customer controls the asset as it is being created or enhanced. The company does not have an alternative use for the asset created or enhanced, and the amount is collectible. Recognizing revenue when or as each performance obligation is satisfied, step 5, 3 of 4. A company recognizes revenue from a performance obligation over time by measuring the progress towards completion. The determining factor is still the transfer of control from the company to the customer. Example, 2-year contract for cleaning services. Price of 2-year contract $30,000. Upfront payment required $6,000. Payment per month $1,000. Revenue per month $1,250. First payment $7,000. 1 performance obligation over time. Total contract price is divided evenly over the 2 years. Journal entry for first payment, debit cash $7,000, credit unearned revenue $5,750, credit service revenue $1,250. Recognizing revenue when or as each performance obligation is satisfied, step 5, 4 of 4. Most popular method to measure progress toward completion is the cost-to-cost method. Measures the percentage of completion by comparing costs incurred to date with an estimate the total cost of the contract. 1 to recognize licensing revenue. Intellectual property. Right to use intellectual property, example, historical work of art, recognize at a point in time. Right to access intellectual property, which is changing over time, like team logos, recognize over time. Summary of the 5-step revenue recognition process 1 of 2. Step and process. 1. Identify the contract with customers. Description. A contract is an arrangement that creates enforceable rights or obligations. Implementation. A company applies the revenue guidance to contracts with customers and must determine if new performance obligations are created by a contract modification. Step and process 2. Identify the separate performance obligations in the contract. Description. A performance obligation is a promise in a contract to provide a product or service to a customer. A performance obligation exists if the customer can benefit from the good or service on its own or together with other readily available resources. Implementation. A contract may be composed of multiple performance obligations. The accounting for multiple performance obligations is based on evaluation of whether the product or service is distinct within the contract. If each of the goods or services is distinct, but is interdependent and interrelated, these goods and services are combined and reported as one performance obligation. Summary of the 5-step revenue recognition process 2 of 2. Step and process 3. Determine the transaction price. Description. The transaction price is the amount of consideration that a company expects to receive from a customer in exchange for transferring goods and services. Implementation. In determining the transaction price, companies must consider the following factors: variable consideration, time value of money, non-cash consideration, and consideration paid or payable to the customer. Step and process 4. Allocation the transaction price to the separate performance obligations. Description. If more than one performance obligation exists, allocate the transaction price based on relative fair values. Implementation. The best measure of value is what the good or service could be sold for on a standalone basis. The standalone selling price. Estimates of standalone selling price can be based on 1. Adjusted market assessment, 2. Expected cost plus a margin approach, or 3. A residual approach. Step and process 5. Recognize revenue when each performance obligation is satisfied. Description. A company satisfies its performance obligation when the customer obtains control of the good or service. Implementation. Companies satisfy performance obligations either at a point in time or over a period of time. Companies recognize revenue over a period of time if 1. The customer controls the asset as it is created, or 2. The company does not have an alternative use for the asset. Earnings approach, ASPE. Revenues for the sale of goods are recognized when the following criteria are met. 1. Risks and rewards of ownership are transferred to the buyer. 2. Seller has no continuing involvement in or effective control over the sold goods. 3. Costs and revenues can be reliably measured. And 4. Collectability is probable. Used under ASPE, ASPE provides little guidance with respect to measurement and collectability. Other revenue recognition issues. There are several situations where revenue recognition issues arise. This is based on IFRS 15, as ASPE has little specific guidance in this area. The situations are repurchase agreements, bill and hold, principal-agent relationships, and consignments. Repurchase agreements. Issue. Repurchase agreements. Description. Seller has an obligation or right to repurchase the asset at a later date. Implementation. Generally, if the company has an obligation to repurchase the asset for an amount greater than its selling price, then the transaction is a financing transaction. Raises the question, did the company actually sell the asset? Was there a transfer of control? One aspect of control is the ability to prevent other companies from directing the use of and receiving the benefit from a good or service. Likely control stays with the company if it intends to repurchase. Generally reported as a financing transaction, borrowing using a contract liability account. Bill and hold arrangements. Issue. Bill and hold. Description. Results when the buyer is not yet ready to take delivery but takes title and accepts billing. Implementation. Revenue is recognized depending on when the customer obtains control of that product. A contract under which one entity bills a customer for a product but retains physical possession of the product until it is transferred to the customer at some point in the future may occur when the purchasing company has limited available space for the product, delays in the production schedule, more than sufficient inventory in its distribution channel. Must meet 4 criteria to establish transfer of control. 1. The reason to hold the inventory must be substantive. 2. The product must be identified separately and belong to the customer. 3. The product must be ready to ship. 4. The company cannot use the product nor sell it to another customer. Principal-agent relationships. Performance obligation in a principal-agent relationship. Principal. To provide goods or perform services for a customer, for example, airline. Agent. To arrange for the principal to provide goods or perform services for a customer, for example, travel agency. Amounts collected on behalf of the principal are not revenue of the agent. Revenue for the agent is the amount of commission it receives. The principal recognizes revenue when the goods and services are sold to a third party. Indicators that a company is an agent. The other party is primarily responsible for fulfilling the contract. The company does not have risks associated with the inventory. The company does not have the ability to set prices. The company receives commission. The company does not have customer credit risk for the amount receivable. Consignment sales, 1 of 3. Manufacturers or wholesalers, consignors, deliver goods to the dealer, consignee, but retain title until they are sold. Consignor is the principal and the consignee is the agent. Inventory is carried on the books of the consignor, not the consignee. The consignment process. Consignee accepts merchandise, agrees to exercise due diligence in caring for it and selling it. After a sale, consignees set up a liability for the net amount due the consignor. Consignee remits the net amount cash received from sales after deducting commission, revenue, and chargeable expenses to the consignor. Consignor recognizes revenue only after receiving notice of the sale and the cash remittance. Consignment Sales 2 of 3. Example: consignor company ships merchandise costing $36,000 on consignment to consignee store. Consignor pays $3,750 of freight costs, and consignee pays $2,250 for local advertising costs that are reimbursable from consignor. By the end of the period, consignee has sold 2/3 of the consigned merchandise for $40,000 cash. Consignee notifies consignor of the sales, retains a 10% commission, and remits the cash due to consignor. Journal entries required. For the consignor, shipment of consigned merchandise, debit inventory on consignment $36,000 and credit finished goods inventory $36,000. No journal entry for consignee. The payment of freight costs by consignor. Debit inventory on consignment $37.50, credit cash $37.50. No entry for consignee. Consignment Sales 3 of 3. Payment of advertising by consignee. Consignor, no entry. Consignee, debit accounts receivable $22.50, credit cash $22.50. Sales of consigned merchandise. Consignor, no entry. Consignee, cash $40,000, credit accounts payable $40,000. Notification of sales and expenses and remittance of amount due. For the consignor, debit cash $33,750, debit advertising expense $22.50, debit commission expense $4,000, credit revenue from consignment sales $40,000. For the consignee, debit accounts payable $40,000, credit accounts receivable $22.50. Credit revenue from consignment sales $4,000 and credit cash $33,750. Adjustment of inventory on consignment for cost of sales. For the consignor, debit cost of goods sold $26,500, credit inventory on consignment $26,500. For the consignee, no entry. Presentation 1 of 2. Contract assets and contract liabilities must be recorded on the statement of financial position. There are 2 types of contract assets: unconditional rights to receive consideration, receivable; conditional rights to receive consideration, contract assets. A contract asset occurs generally when a company must satisfy another performance obligation before it is entitled to bill the customer. For contract assets, it is important that financial statement users can differentiate between unconditional and conditional rights. A contract liability is a company's obligation to transfer goods or services to a customer for which the company has received consideration from the customer, unearned revenue. Presentation 2 of 2. Costs incurred to obtain a contract are treated as assets as long as they are incremental, would not have been incurred unless the contract was obtained and recoverable. Costs incurred in completing a contract, known as fulfillment costs, may be treated as an asset as long as they relate directly to the contract, enhance or create economic resources that can be used in the future, are recoverable. General and administrative costs, unless explicitly chargeable to the customer under the contract, and wasted materials and labor are expensed as incurred. The incremental costs of obtaining a contract are expensed when incurred if the amortization period of the asset would have been less than 1 year. Disclosure 1 of 3. The disclosure requirements for revenue recognition are designed to help financial statement users understand the nature, amount, timing, and uncertainty of a revenue and cash flows arising from contracts with customers. To achieve this, companies disclose quantitative and qualitative information about the following: contracts with customers, significant judgments, assets recognized from costs incurred to fulfill a contract. Some of the disclosures used by companies to meet the quantitative and qualitative information requirements are summarized on the next 2 slides. Disclosure 2 of 3. Disclosure type. Disaggregation of revenue. Requirements. Disclose disaggregated revenue information in categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors. Reconcile disaggregated revenue to revenue for reportable segments. Disclosure type. Reconciliation of contract balances. Requirements. Disclose opening and closing balances of contract assets, such as unbilled receivables, and liabilities, such as deferred revenue, and provide a qualitative description of significant changes in these amounts. Disclose the amount of revenue recognized in the current period related to performance obligations satisfied in a prior period, such as from contracts with variable consideration. Disclose the opening and closing balances of trade receivables if not presented elsewhere. Disclosure 3 of 3. Disclosure type. Remaining performance obligations. Requirements. Disclose the amount of the transaction price allocated to performance obligations of any remaining performance obligations not subject to significant revenue reversal. Provide a narrative discussion of potential additional revenue in constrained arrangements. Disclosure type. Costs to obtain or fulfill contracts. Requirements. Disclose the closing balance of capitalized costs to obtain and fulfill a contract and the amount of amortization in the period. Disclose the method used to determine amortization for each reporting period. Disclosure type. Other qualitative disclosures. Requirements. Disclose significant judgments and changes in judgments that affect the amount and timing of revenue from contracts with customers. Disclose how management determines the minimum amount of revenue not subject to the variable consideration constraint. A comparison of IFRS and ASPE, 1 of 3. IFRS 15, recognition. Contract-based approach, asset liability approach with 5 steps. ASPE, earnings approach. IFRS. Recognize revenue when performance obligation is satisfied, when control passes. ASPE. Recognition when performance is achieved. Risks and rewards have passed and services are rendered immeasurable and collectible. IFRS. Recognize revenue for each distinct performance obligation at a point in time or over time. ASPE. Recognize over time for long-term contracts. IFRS. If providing goods and services together, must consider if performance obligations are interrelated. If they are, treat as one performance obligation. ASPE, we don't have any guidance. IFRS. Assurance-type warranties are accrued as costs or liabilities, and service-type warranties are treated as separate performance obligations if sold separately. ASPE. Warranty costs have historically been accrued as costs and obligations when revenues recognized. More recently, these may have been accounted for as bundled sales or unearned revenues. A comparison of IFRS and ASPE, 2 of 3. Measurement, IFRS. Transaction price is the amount that the entity expects to receive. ASPE. A transaction or consideration price, which is generally assumed to be fair value. IFRS. Greater emphasis is placed on using measurement models to quantify risk and uncertainty. And we don't have that under ASPE. IFRS. Guidance is provided as to how to calculate discount rate where the sale is financed. If the term is less than 1 year, there is no need to separate out the financing component. ASPE. Where payment is received over time, ASPE notes that the amount should be discounted using a prevailing market rate. IFRS. Where variable consideration exists, revenue is recognized only if it is highly probable that a future reversal will not occur, and no guidance for ASPE. A comparison of IFRS and ASPE 3 of 3. IFRS, measurement. The transaction price for transactions with multiple elements is allocated using relative value, although may estimate where not available, and may use residual method to estimate. Specific guidance is given. With ASPE, the transaction price for transactions with multiple elements is allocated using relative value or residual value method or choice. IFRS, where a right of return exists, a refund liability is recognized. ASPE, where a right of return exists, sales returns and allowances are recognized as contra accounts to revenues and accounts receivable. IFRS, IAS 41 deals with biological assets. It still stands because the proposed standard does not cover these areas. ASPE, accounting for biological assets, is not explicitly discussed. Given that ASPE guidance is general and high level, and IFRS 15 provides a fair bit of insight as to the nature of different revenue contracts, these insights may find their way into ASPE informally, even if the wording of the standard is not changed.